feast or famine. It's like, to me, that's a symptom of insufficient lead flow, and that is a marketing problem.
So many founders that are just deeply embedded in the day-to-day beyond being on sales calls. They're writing code, they're moving designs around in Figma, like doing things that they definitely shouldn't be doing. And so you've gotten to a point where you're hands off on almost all things. What was that process like?
You find yourself in a situation where you can invest in the talent you need and lose money or not be profitable, or not invest in the talent you need and continue to be stuck in your business.
Most agencies are running on a cash accounting model, so they're not even thinking about anything beyond that. Welcome to Agency Bytes. I'm your host, Steve Guberman from Agency Outsight, where I help agency owners build the business of their dreams. On this episode of Agency Bytes, my guest is Sam Shepler. Sam is the founder and CEO of Storysnap, a holding company that owns Testimonial Hero and Product Type. He's been building agencies in the B2B video space since 2012, growing largely through strong operations and strategic acquisitions. Today, he leads a team of more than 50 and is focused on starting, scaling, and buying agencies, helping founders build businesses that are profitable and don't depend entirely on them to run. Sam, I'm super excited to dig into what you are doing at Storysnap and in the M&A space. So thanks for joining me.
Thanks, Steve. Yeah, it's a pleasure to be here and really excited to chat today.
Yeah. Give kind of the backstory. 2012, you jumped into the agency space bold and courageous and going to do it better than the rest of us, and quickly learned a lot of lessons along the way. Give us kind of the quick story on, what you've been up to.
Absolutely. So yeah, 2012, I was finishing up my master's in communications, and I had done undergrad in film. So I had some video chops, got read the 4-Hour Work Week, got the entrepreneurship bug from reading that book. And I was like, okay, what sort of skills do I have that I can apply? And the only one I could come up with that was really feasible was my video, background. So started a extremely laborious and unscalable generalist video agency, doing any type of video for anyone who would pay us, essentially, with a couple of good friends out of our college apartment initially, and built up a decent sized, generalist B2B, mostly B2B video agency from 2012 to 2012 to 2016. Was able to get that acquihired on April 1st of 2016 by a national PR company. Spent a little under a year there, then took a year off took 2017 off. Swore I would never do anything in the agency world again, because I was frankly like a little burned out, just like a lot of people. But none of my other non-agency ideas were working out. So I was like, I'll productize something. That was what was hot in 2018. It was the productized services. So I was like, I will productize one of our best performing products at my first agency, which was customer testimonial videos. So that was the genesis of Testimonial Hero. Started Testimonial Hero in 2018. Have grown that over the years. Launched Product Type last year. Now cumulatively, we should hit 8 million in top line revenue in the group this year. Got a team of 50 plus, and yeah, really, really happy that I didn't give up on the agency life, because I've come full circle, and now I am a huge proponent of it. When done correctly and with the right team to support you.
Yeah, I love that. And at what point did you did the acquihire, which was kind of your first foray into M&A. At what point did you realize that you can flip that into, I can be growing through strategic acquisitions?
So it's a good question. So I think for us, like, our strategic acquisitions have been just as much around adding capabilities as they have been around adding revenue. And I think the line blurs, because you add capabilities that drives revenue. But I do think there's a lot of ways to add revenue. You can spend more on marketing dollars and grow like that too. I think the really exciting acquisitions, and I would put the two of the ones that we've done publicly so far in this category, is like when you can add a new capability and expand your arc of services. So we only did video testimonials, and then we acquired two companies who specialize in written case studies, PDF case studies, long form, blog articles around the customer story. So we were able to add that capability super quickly. Those deals specifically came from just long-term relationship building and having a good relationship with the founders for years, I think, before, they ever wanted to sell. And yeah, I think that it was definitely something, it's one of those things where, yeah, I try not to like think of it as like competition. I try to think of it as like co-opetition, like portmanteau of collaboration and competition, co-opetition. So it's like big proponent of like building those, real relationships with your competitors, because your competitors per se are often your best partners, your best referral partners, your best acquisition targets, or your best people that if you want to sell your agency to, they might want to acquire you. So I think that's, an important thing to think about for sure.
Yeah. There are a lot of different ways. So video production, I think, is a tough, I guess, deal flow nut to crack, as far as most of the clients that I've worked with and peers that I've had in the space, and even partners that I worked with when I had my agency, were very feast or famine. They were very project based. It was very hard to convert into retainer, which is what they thought they needed to move into for the perceived security of retainer relationships and things like that. And I think a lot of that is, they look at typical ad agencies and AOR deals, and they're like, why can't I get that for the video world? And it doesn't exist in the B2C space, obviously. You're not getting retainers for weddings and nonsense like that. But certainly in the B2B space, when you're selling video production and video services and subscription based stuff, you went into the product verse trying to get into how do we convert this into AOR or retainer based work. What was the mindset behind that?
The short mindset was initially it was so challenging that we're like, just like, screw it. We're just going to make it work regardless. We certainly wanted to, but I think over time, in hindsight, my now kind of, understanding of the situation is, and again, this is just my 2 cents, but I think that more that lifetime value, and more specifically lifetime gross profit, is the metric to optimize for. And if you actually are increasing your lifetime value of a customer by selling them, you might be able to sell them, $450,000 packages over, 2 to 4 years, and have that, 200K LTV. Whereas if you force them into a sort of retainer model, and it's really questionable if the service really demands a true retainer relationship, and like, because that's what a lot of people try to do with video production. So they're trying to kind of shove a square peg in a round hole, right? Like you might do a 10K retainer that churns after 5 months. That's a 50K lifetime value, right? So and so for me, I just think this, look, like we're okay with like short-term volatility, and we're maximizing for lifetime value in the long term. Furthermore, I actually think this is more of a philosophical take, but like I actually think that like unpredictability is like the spice of life. So it's like I don't personally like agree with trying to like cure a business of its unpredictability. That's kind of, and I especially don't think it makes sense to do that with a billing mechanism. I think, if you want to solve, you said it yourself before, is like the feast or famine. It's like that is to me, that's a symptom of insufficient lead flow, and that is a marketing problem. So I think it's like I think there are a lot of priorities are getting inverted, and people are trying to solve a lack of marketing effectiveness with the billing mechanism, when you really just need to generate so many leads that you're never going to be in famine mode. You're always going to be able to, effectively feast, or feast a little bit less or more, but like you're always going to have enough leads that, it's volatility, but it's all uptrending to the right direction.
I don't think most founders look at the sense of security or volatility the way that you just kind of, I don't want to say reverse engineered it, but pointed it to the true symptom of the problem, as opposed to, well, we don't have enough, cash in the bank or cash on hand or projection out for, the next, whatever, 6, 9, 12 months. And they're quick to say, yeah, it's just how a billing structure works, like you said, or we don't have enough closed business. But the true symptom of the problem, like you said, is top of funnel or mid funnel or what stages of the deal flow you have. So many founders just don't look at it from that lens, which is just mind boggling to me. So yeah,
It's true.
points to marketing. I love that.
Yeah, it's true. And the thing is, it requires like original thinking and lived experience. And original thinking is rare. Like not a lot of people think for themselves. They can't be all, and I've been there. And like it took a lot of lived experience for me to kind of come to my own, conclusion here
Mhm.
over, going on 8 years of running a project based business that's blasted through the $2 to $3 million plateau that most agencies get stuck at. So yeah, I mean, I think yeah, just kind of I felt the same way until like I realized, oh wait, you know, this is kind of working. Why is this working? Oh wait, we're getting really good at marketing. So like that's kind of how I, had to kind of learn it on my own.
Yeah. And like you said, they'll get stuck at I even see it way before 2, 3 million, like 1 to 2 million is where they get stuck on project based. And if they're growing into a retainer, they're most likely growing responsively and not strategically. And so and it was my story. We're going to bid on this AOR account. If we win it, we're going to need to onboard a dozen people and double our size overnight. And now we're imbalanced and we're growing very responsively, not strategically. Whereas when you grow project based or small client over small scale over large scale, you can do it responsibly. You don't need to add volume of people and resources that might not be utilized to their fullest capacity yet. So, at the scale that you're at, 8 million, you're basically hands off in the day to day.
That's 100% correct. Yeah, I'm 100% focused on the whole co level things. You're figuring out what's the next acquisition that we might want to make, what's the
Hmm.
next incubation that we might want to make, because if we see that we want to, if there's a space that we want to compete in and we can't get any deals closed in that space, we will start an agency in that space as a as a fallback option after
Hmm.
exploring all other options for acquisition. So yeah, that's and I think also I would note like I don't think my way is the best way necessarily. Like I think it just works for my personal proclivities and temperament and
Hmm.
how I really like that 0 to 1 phase of starting new things. I know, a lot of I know a couple agency owners who are running $20 million agencies and they're very in the details. They're still hopping on sales calls. And like I think there's a lot to be said for that. And that's probably why they're running a $20 million agency and I'm running an $8 million agency. But I'm just like to me, like that just feels a bit feels a lot heavier energetically to me. And I just want to be kind of helping in that 0 to 1 phase. And if I am, gonna take longer to get to where they are or not get to where they are, like that's okay. Like I'm kind of on my own journey. And that's like basically like I think there's trade-offs I've made to be as like there's trade-offs on both sides. But for me, it's like I got to be true to myself and like what gives me energy, provided I can still like make the company hit the metrics and year-over-year growth and margin targets that we need to hit.
So, can you talk about some of the things that you had to do or put in place or let go of in order to be out of the day to day? Because I think even at a quarter your size, the 1 to 2 million, there's so many founders, 3 million. There's so many founders that are just deeply embedded in the day to day beyond being on sales calls. They're writing code, they're moving designs around in Figma, like doing things that they definitely shouldn't be doing, and so you've gotten to a point where you're hands off on almost all things. What was that process like?
Yeah, so I think so I want to talk about like some root cause stuff and then some more like tactical stuff, but
Mhm.
like at a very high level 10,000 foot level, it's all about obviously no surprise, like getting the right team in place and getting the right functional leaders in place. And I think everyone sort of knows that, but then when they're at $2 to $3 million and they look at their P&L such that it is, and they were like, oh, I need to replace myself from sales, where in the P&L is a sales rep who's going to be 80% as good as we got to come from. like that's going to make me unprofitable, right? So like it's really quite simple in the sense that it's all about getting the right people on the bus in the right seats. But a lot of times the business isn't healthy enough to support those investments, frankly, right? So without the founder taking a huge pay cut, that's the caveat, right? It's like you can like I think a lot of people, and again, I've kind of been in this position, so like this is me speaking from experience until I fix the financial health of our P&L and our balance sheet, me and my team, like once we realize this. But it's like, yeah, like if you don't have a good enough gross margin to begin with, like I think that everyone should have a minimum 50% gross margin, and that includes like every cost that goes into delivering your service, like even your software that's related to delivering the service, obviously the in-house team, even yourself as the founder. If you're doing 25% of your time in account management, you should 25% of your salary should be in cost of goods sold. So basically, like it starts with people, in my opinion, in my experience, after looking at a lot of agency P&Ls and for deal flow, it's like people aren't calculating their gross margin correctly. It's much lower than it should be. They should be at least 50%, really like closer to 60% plus, but they're at like 30 to 40%, and they don't know it because their CPA is doing their books, and CPA does their books for tax purposes. What does the IRS care about? They only care about net margin. CPA doesn't care about gross margin. No, they're not incentivized to care or know about your gross margin at all. And so basically you find yourself in a situation where you can invest in the talent you need, or and lose money or not be profitable, or not invest in the talent you need and continue to be stuck in your business. So I can go on, but I think a lot of it comes to like people don't have the cash on hand in the margin to make the investments that are going to get them to the next level, because they don't realize how unprofitable they are at the project delivery level.
So 50, I like to push to 55% on the gross profit margin, being defined as healthy. In your mind, that's what allowed you to get out of the day-to-day, to put the resources in place so that you can be hands-off, to invest in people, and maybe that dips your gross margin, but it'll rebound when you put the right resources and right people in place so that you can be hands-off. And that was for you a strategic and very intentional process, so you can focus on M&A and the holdco side of things.
Yeah, correct. And I also like 55 plus. I say 50 is the minimum because it's so easy to do mental math with 50. It's just like, okay, you're delivering a project for, 10 your 10 grand a month retainer, or your 10 grand project. Don't let it cost more than $5,000. So like, right. But yes, I think in with AI, I think like 60 is the new 50, right? 65%, so like, but yes. So I think like, and I think a lot of times the investments that people need to make in their team are actually going to fall in that operational expenses and that OpEx segment of the P&L. And so it might be like, for example, I have a president. He previously was a general manager, and now he's the president. And before that, he was the VP of operations. Big investment to get me out of the day-to-day of the operations. He's 100% in categorized as OpEx. So, if I didn't have that, that high enough, gross margin to start with, I couldn't make big OpEx investments. I can't hire salespeople because then all of a sudden I'm not profitable. I can't spend 10% of revenue on marketing and 10% of revenue on sales talent. And so it's like, that's the other thing is like, I think we can afford, I think if you set your P&L up correctly, you can afford to take big swings at marketing experiments that they're not all going to hit, right? But you can take, 10, 20, 40, 100 grand, swings, and they don't all have to work out as long as you have that margin of safety.
Yeah. Yeah, a healthy P&L, healthy balance sheet is vital for making the investment back in. And talk about how that impacts when you're looking at companies to vet for an acquisition, and you see maybe there's a dip because there's an investment dip in their gross margin, or that trajectory pauses or stalls out and then dips again, or like talk about how that impacts what you're looking at when you're vetting agencies.
For sure. So I think for us in particular, like we don't mind we don't mind helping to polish rough diamonds. So we like that stuff doesn't bother us personally at all because of our sort of operating model where we are looking to like our core target is like other specialty, specialist video agencies,
Mhm.
essentially. So like we have so much operational and like shared services and finance and ops admin that we can deploy once we acquire these companies that like we see that as like kind of value creation. So it like doesn't scare us away compared to like another acquirer who's like, oh, like this company has to be really in good shape because I'm just gonna like let someone run it and so we're very hands on and supportive. So we'll fix all that stuff. I think for us, like the biggest, and I think that's like a lot of our value prop as a buyer is like we're able to help founders who are stuck kind of you know blast through that sticking point, get access to the support and finance help and marketing help that they weren't able to have, and let them kind of focus on what they love to do, what gives them energy, what's their highest and best use, their superpower, right? And abstract away all the other kind of day-to-day minutia stuff. So yeah, I think like for me, like I don't mind at all if I see that stuff. I think what I do like to see is, I mean, I think there's some specific stuff around like, oh, does this fit in our, portfolio, or is it like a specific thing we haven't done yet that we think we can cross sell to our customer base? I think, but at the end of the day, it's like all about the people and like the culture fit. And it's like, is this founder someone who would be a good culture fit with us? Obviously, good clients that they hopefully can bring. Lack of major client concentration issues is a big one. Like if significant, if like a third of the revenue is from one client and that client leaves, I mean they've just dropped
Yeah.
significantly, right? So like just I think the typical stuff. But yeah, I think we're very we get excited when we see something that needs a little bit of work because we know we can help them and add value and create value.
One thing you said I love that's just an indicator of cultural alignment, where you said earlier in the recording, you want to do things that you know kind of speak to your passion points, your value. You want to spend time doing that. And you just said that you want to find people to acquire who are also looking for that opportunity. And that's not something I hear too often. Like, sure, we want cultural alignment so integration works, but for you to want to identify founders who you can help lift them up, polish what they've been working on that's having some problems, and give them an opportunity to run with it. I mean, that is just, I think, one of the best intentionalities about, M&A.
100%. And I think it's hard to find because yeah, a lot of times, so a lot of buyers don't have a deep bench of operational experience in the same industry or in that they can apply. But yeah, we're fortunate to be able to have that. And we can do turnarounds. We can do, you know, in many cases, like we like I said, like we're more excited about like a slight turnaround or like a rough diamond than we are about like a perfect company who frankly like might not need us. They're doing it right. Like keep doing you, like.
Yep. You mentioned AI has kind of shifted what you want to see in a gross profit from 60 is the new 50 kind of thing. And so I do think there's a lot of impact that AI is having, but I'm curious if you think those numbers are different in video versus web dev or design or branding or strategy, the different like delivery modalities that an agency might have. Or do you think that that's kind of in your mind a hard and fast rule, no matter what the delivery is?
Yeah, it's a really good question. I guess I'll give my best answer because I don't have a lot of experience in design or in whatnot. But I think for us, let's just say like any project based work essentially, right? Because I think that
Mhm.
so we calculate the gross margin in a vacuum, like is it at the project level. So we're like what's every single resource that's going to be on this project and how many hours and what's their hourly rate and everything. It's like so in a vacuum with like which isn't how projects work in reality. But like we'll start at a vacuum. We like that vacuum gross margin to be like well above 70, because we're expecting like at least 10%, decay on that gross
Hmm.
margin in real life on a P&L, like on a monthly situation, because no one's 100% utilized, and full-time resources are still costing you money full time, right?
Right.
So basically, yeah, and of course, if you're in a smaller scale, and a lot of your delivery people or contractors, then maybe you won't have that much decay, because you're able to just pay, like, okay, the price is the price, and they're not full
Right.
time. But like as soon as you have people full time, you can't and don't want to fully utilize them, that they will burn out. So you have to like plan for that sort of that decay. So for us, we try to start at like 70% plus, gross margin in a vacuum, and then expect it to drop, 10 to sometimes a little bit more, like when it
Hmm.
actually hits the monthly P&L. And then
Yeah.
of course we're especially focused on the quarterly goals, and that's kind of the waterfall. And like, I incentivize my president to hit, a significant portion of his comp is based on, or of his bonus comp is based on hitting gross margin targets
Yeah.
on the quarter. So like that's ultimately, like that's how we like evaluate it at the end of the day, is like the month and the quarter, just starting at a good place. So because we know it's going to go down in the messy real life
Gotcha.
world.
Yeah. You talked about three different areas of an agency, the poor gross margins being most important part of P&L for you, or not poor, but like, gross margins being the most poor part. And we touched
Yep.
on briefly cash flow as it pertains to project based or retainer based, but the third is that lack of specialization. And talk about kind of in your mindset what these trifecta of would you call them agency mediocrities, how they work together or don't work together in the ecosystem.
Yeah, for sure. And before I talk about specialization, I'll say last thing on gross margin, like it is actually like baffling. I'd say it's baffling, but like I've been there too. So many years ago, so like I get it, but it's baffling to me that like you ask people their gross, like what's your gross margin, they will give you your net margin. They're
Yeah, they don't
like
know the difference.
they're so for such an important part of the health of your agency, which is it's literally your unit economics. It's like this is what you make, and these are your fundamental unit economics. Like the lack of conceptual understanding of it is an existential risk to your agency if you don't understand it, because it's like, just to tie the bow on it, it's like, like on the net margin side, you can flex a lot of stuff. Like you can decide that you don't want to attend Dreamforce this year, or you can
Right.
decide that you don't want to spend, 10K on that flashy like marketing expense. Like everything in OpEx is like fungible, but like your gross margin, you can't drastically adjust it. Your gross margin is going to be affected by raising your prices, which is a really good thing to do. And that's the best, easiest way to increase your gross margin. But as we all know, you can't just raise your prices 20% out of nowhere and expect all your customers to go along with it, right? So, or drastically cutting your costs. But it's like both of those things are not easy to do out of thin air. Like so, like
Right.
that's why to me it's like it's so important to get that right, because like if you don't get it right, you're fighting a uphill battle the whole way, right? So hopefully that helps people. Like if they're not fully, they're like, I don't know, like maybe I don't need to, get know my gross margin. It's like, no, it's really important. So, and it's really important if you want to scale and grow. Like I'll say that, like if you want to stay and like run an awesome, sub, $2 million, $1 million, lifestyle business, and like you're okay to do the work, like that's fine. You can have a great income like that. But if you want to like scale and truly remove yourself, you do have to figure it out. I kid you not, like I've probably looked at 15, 16 agency P&Ls for the last year.
Mhm.
It's not a single one of them was doing their gross margin correctly. I have yet
Wow.
to see an agency P&L that, and again, I look at a lot of video production things. So like and they're all like, mostly sub, $1 million to sub 2 million. Actually, some of them are larger, and they're not correct either. But so maybe it's a video production thing, specifically. But yeah, I've never seen someone calculate their gross margin correctly. Yeah, in an agency.
Interesting.
Ever.
I don't know that I've
So
looked at as many video shops, maybe only, I don't know, a handful in my career, maybe 8 or 9. And I wonder if it's the model of so many subcontractors that they're not doing it properly, or something specific to their delivery mechanism that they're not doing. Because on the web and software and creative side, I've seen it closer to better, but still not
yeah,
perfect.
yeah,
So interesting.
yeah. It's
Yeah.
a really interesting thing. My theory is that there's this huge misconception, which may be spread by CPAs. I think, because I feel like this is what my CPA told me at one time, and this is what I see, is that all the variable labor that should be COGS, like all the freelancers and contractors,
Hmm.
are put into COGS correctly, but all the in-house labor related to that should be in COGS, like their in-house customer, client project managers, or in-house video editors, anything to do with delivering the work. For some reason, there's this misconception that that only variable labor is COGS. That seems to be the misconception I've run into, because like people are putting their people who are in delivery, they're putting them in OpEx. But again, if they're related to delivery, they should be in cost of goods sold. So that's for whatever reason. If that's the misconception you have, all you need to do is Google what goes in cost of goods sold under GAAP accounting principles. You have the answer. It's very black and white. So hopefully that helps people. Yeah.
But before you dig into the next, you just said something vital. You said GAAP accounting principles, and most agencies are running on a cash accounting model. So they're not even thinking about anything beyond that. They're not working with a CFO sub 5 million.
Yeah.
So yeah,
Yeah.
there's our
And
issue.
that's a really good point. I guess that's such a good point. And I think, and again, I've been there too. So like, I think the secondary point is like, just people need to understand that, like, if you're running a project-based business, you want to grow and actually know what your business is doing, you need to transition to accrual, because your P&L on a cash basis is a really good cash flow statement, but tells you absolutely nothing about the performance of your business
There.
on a project basis if you're doing cash flow. It's incredibly important for understanding your cash flow, but it doesn't actually tell you anything about your business performance. That's where we need to switch to accrual to actually truly align revenue and expenses. Like, to your point, exactly. Like, most people are like, wow, March was a great month. And then they're wildly profitable in March. A client just like prepaid them for like 6 months in March, but like none of the work was delivered, So it's like, you didn't actually earn that revenue. So like now, like maybe we should do another episode talking about accrual and all that. But yeah, that's such a good point. And I know you said that the cash flow thing, I don't want to forget that. Yeah.
Yeah. Yeah, I mean, I wanted to kind of dig into that trifecta that you were talking about, but yeah, I might need to pull in another agency CFO to demystify the P&Ls and different accounting practices, and how to really track cash flow beyond the giant check you just received, because that's a lie.
100%. It's
Yeah.
great, and I'm a big proponent of it. And this is I know we're coming up on time, but to kind of put the bow on the cash flow, so like there's this funny paradox where like the best way to create cash flow is the worst way to have accurate books, unless you switch to accrual. So it's like I'm a huge proponent for getting that huge check, and that's what I would 100%, 100% advise. Like, pull that revenue forward, do whatever you can to pull that revenue forward. Monthly billing is always going to be worse than getting billed, quarterly in advance. And I'm not anti retainers. Like, I'm not anti thing. I think like LTV, whatever maximizes for that. But I would always rather get paid in advance so I can redeploy that money, especially when I think about my customer acquisition cost payback period. So like we do probably a lot more marketing than most agencies do. So and maybe we can get into that. But like when it comes to scaling our marketing, it's all about like our CAC payback period, where so as long as you can like liquidate your marketing costs quickly, you just keep feeding the machine, keep reinvesting in marketing. So like, if we're talking retainers of 10K a month, I'd rather get paid 30K on month one, because it's going to cost me, maybe it cost me, 20K to acquire that customer. And I want to get out of that hole as soon as possible, put another 20K in the sales and marketing machine, repeat, rinse and repeat. So it's like, if it costs me 20K to, acquire that customer, then I'm not even going to be breaking even until 2 months into the retainer. So like so that's the thing is like, but I've seen firsthand like people turn down clients wanting to pay them in advance because they like the P&L view of money coming in every month. They don't like to look at their forecast and say, oh, there's no money coming in this month. I get it emotionally, but like logically, if we had our logic hat on and we think about the time value of money, no way. You got to pull that revenue forward.
And also, when you get a large infusion like that, it's an opportunity. So you're not realizing that revenue until you actually do the work on the books, but you're realizing this is an infusion to invest in a thing that I need to invest in. It's rare that you're going to get that cash infusion, 50, 100K all at once. And when you get it, to your point, 10K a month, the margins are going to be so lean that you're not going to have any bubble to invest in. So yeah, we can dig into the mechanics and metrics of marketing and the investment there and CAC and all that stuff. But let's not open that can of worms today.
Yeah, we'll save that for the next one. But yeah, that's exactly right. And like, and then just so people don't claim that we never told them about deferred revenue, that's another really important part when we're talking about pulling revenue forward, is that you do need to track your deferred revenue. Like when you're on accrual, like all of this will be technically be debt on your balance sheet, and it's like a liability because that's like promises of work owed. So like, hopefully it goes without saying, but we'll say it anyways. Like, don't just go and spend all that money. Like that's you have to actually deliver that work. But like you can be smart about it and like make some big investments that maybe you couldn't otherwise made before. So it's like, it all comes down full circle around like that like need to, like, if you really want to scale and you're doing projects, you have to be able to do both cash and accrual accounting. Like we do both. We still file our taxes on a cash basis, but like for actual performance, business performance, like accuracy, it's got to be accrual.
Yeah, oversight is accrual, and most tax filing will be cash. And I learned that bubble payment liability lesson the hard way. So, like most of us do. So, Sam, I'm super grateful for all your insight that you shared and the experience that you have, folks. If this P&L conversation is confusing, hit me up. I'll send you some really awesome CFOs to talk to that'll handle it for us. But let's wrap up with a couple random rapid fire questions for you. The first is, what is a book or show or podcast or something that you are binging the heck out of and can't get enough of these days?
Oh, that's a good question. I've really liked David Founders podcast, and also his new podcast. I think it's just David Center.
Awesome. What is a gadget or something other than AI that you have recently integrated into your life that you look back and you're like, how the heck did I live without this thing?
Oh, I got a good one here. So mechanical watches. So I used to be really big and mechanical watch enthusiast earlier in my life. Then I went smartwatches during COVID when I didn't see anyone, and now I'm back to mechanical watches, and I just really appreciate it's engineering, it's art, it's a philosophically different way to look at time compared to like a digital display. Just seeing the sweep of the hands, and I think everything is so digital. It's nice to have some analog in our lives.
Love that. Yeah, big fan of that. And then finally, what's an invaluable piece of business advice that you look back and you're like, man, I wish I had this earlier in my career you can share with people?
Oh, that's such a good one. I don't know if it's like I'll say one that's standing out to me is like, there's a quote that I like. It's like success isn't standing on top of hierarchies. It's like standing outside the hierarchy. Obviously, it's like very subjective and like but I think for me that means it's like I don't like what motivates me is not necessarily trying to climb the ladder of venture funded SaaS companies or whatever, or because that initially, like especially growing up, started my career in Boston, like that was like the hierarchy. It's like, you're an agency, like we're not even going to talk to you, like you just get like poo-pooed away. But I think it's like, yeah, just kind of finding your own place and like realizing like you don't have to like necessarily climb the prevailing, hierarchy. You can kind of stand outside of it and try to carve your own path there.
Yeah, I love that. And additionally, the way I see that landing for you is as you're putting leadership and people in place, you're helping them elevate with the resources that you're providing them. You're kind of standing off, watching this thing happen based on resources you put in place. So love that for you, Sam. Thank you so much for joining us and sharing so much wisdom and experience with us today.
Thanks, Steve. Yeah, this has been an absolute blast. I appreciate you having me on.